Instead of that $10,000 going directly on your P&L, you're going to put $10,000 as a fixed asset on your balance sheet, and you're going to depreciate that over 5 years. Welcome in everyone to our REI Tax University channel, where we talk all things tax planning for real estate investors. And today we're going to start a series where we get into one of the biggest potential tax planning opportunities there is for real estate investors, and frequently one of the most misunderstood: depreciation. Now, I was going to lead into this series with a good tax joke, but I just didn't know if you'd depreciate it. See what I did there? All right, in all seriousness, enough with the dad jokes. I know taxes and tax planning isn't always the most exciting topic to talk about, but hey, you're the one who clicked on a video about tax planning for real estate investors and depreciation, so it's kind of your own fault that you're here at this point. And while I'm happy for any raving fans that want to follow along with our video here as we go, feel free to throw your phone in your pocket, stick your AirPods in, and just listen along. I'll be sure to let you know if we throw something up on the screen that you need to pay attention to and look at. We're gonna start here in part 1 with Depreciation 101. And I'm gonna do my best to break down depreciation and explain it to you in as simple of terms as we can. So let's start with talking about expenses versus fixed assets. When you have a real estate investment, you have a business. Your investment properties, that's a business. And when we talk about businesses here, we're talking about your real estate investments. So when you have a business, such as your real estate investments, you can deduct any and all ordinary and necessary expenses from your taxes. So think about things like supplies, repairs, insurance, utilities, mortgage interest. All of these items are deductions that you can take to offset your taxable income. You don't need to have an LLC or any type of legal structure to do this. Any business that you start today, you can take these deductions from. Now, we would recommend thinking about setting one of these legal structures up to protect yourself. But again, we're talking about tax deductions here, and it does not change what you can do from a tax deduction standpoint. Now, those items that I just mentioned, those are the ones that are pretty easy to understand. Those are items that are expenses. They're going to go directly on your income statement, or what we frequently call your P&L, your profit and loss statement. So those are things where you're going to show your rent revenue, and then you're going to show these as expenses: insurance, utilities, mortgage interest. You're going to take your revenues minus all these expenses, and that's going to be your bottom line net income. But sometimes the business may make a purchase which doesn't qualify as an expense. And what do I mean by that? Well, when you purchase something large, so just think about something over $2,500, and it's going to have a useful life of more than a year, you may be required to set that up as a fixed asset. And it won't go directly on your P&L, it'll have to go on your balance sheet as an asset. What that means is these purchases aren't being expensed right away. They aren't being deducted right away. They aren't coming off of your revenues right away. So what happens with these larger expenses? These are items such as equipment, vehicles, your buildings, your land, anything additional that you might do to that property. If you get a new HVAC, cabinets, flooring, these are all items which may not be able to be expensed and may likely need to be set up on the balance sheet as fixed assets. For any of these such items, you're going to take the total cost that it took to get that item in service. That is the purchase price, the delivery, the installation, whatever it took to get that going, and that's going to go on your balance sheet as a fixed asset. Now that we've talked about how to set up the fixed asset and what a fixed asset is, it's time to talk about the depreciation on those fixed assets. For any fixed asset purchase, the IRS puts it into a class, and each class has a different depreciable life. It might be 3 years, 5 years, 7 years, 15 years, 20 years, 27.5 years, or even 39 years. Here's some common ones. Land, it never depreciates. So if you buy a property or you buy land, that land is going to go on your fixed asset at that value, and you are never going to expense it. It will sit there and stay on your balance sheet until you sell it. Long-term rentals, these are 27.5-year property. Short-term rentals and commercial rentals, these are 39-year properties. The other common items are 5-year property. That's vehicles, equipment, furniture, flooring, cabinets. There's 7-year properties. That's usually office furniture and fixtures. And there's 15-year properties. That's land improvements, think driveways, fences, sidewalks, things like that that you might have to put on a property. Those are the most common ones. And there's some others that are outside of these, but again, these are the most frequent ones that you're going to see come up as a real estate investor. So what this means is that if you go purchase something like this, let's say you got new cabinets, and the total cost of getting those cabinets and having them all installed was $10,000. Instead of that $10,000 going directly on your P&L, you're going to put $10,000 as a fixed asset on your balance sheet, and you're going to depreciate that over 5 years. $10,000 divided by 5 is $2,000 a year. That $2,000 is your depreciation expense. And that year, it's going to move from your balance sheet to your P&L. So instead of getting $10,000 of an expense for those cabinets, you're going to get $2,000 that year. You're going to get $2,000 next year, and so on for 5 years. Now let's talk about an example that we're going to use frequently throughout this series where you purchase a building. We're going to say that you purchase a long-term rental building for $450,000. Now when you purchase this building, you have to break out the purchase price and the total investment into land and building. And there's an exact calculation you have to use, or your accountant needs to use to do that. But for example purposes here, we're just going to use $100,000 was for the land and $350,000 was for the building. Now again, the land never depreciates. So $100,000 of land is going to go on your balance sheet and it's going to stay there until you sell that property. The building is a long-term rental and it's 27.5-year property. So on the $350,000, you're going to divide that over 27.5 years, and that's what you get to deduct each year as long as you hold the property. So assuming you bought this property on January 1st of 2024, you would have 2024 depreciation expense from the property of about $12,700. $350K divided by 27.5. That $12,700 is your depreciation expense, meaning it's going to move from the balance sheet to your income statement, your P&L. So you now have an additional expense on your P&L of $12,700, and you have accumulated depreciation on your balance sheet of negative $12,700 to bring your building value down. All right, let's look at the example of what we're talking about right now. So you purchased the property, we're calling it 100 Long Road, and this is how that would get set up. First, we've got your balance sheet, and we're gonna set up the building, the land, and we're just gonna assume in this example that you had to put in some flooring, a pretty easy example to follow. So we've got the building, which we talked about, that's at $350,000. We've got the land at $100,000, and then we've got, we'll say you put in some flooring and the total cost there was $10,000. All those items are going to go onto your balance sheet. Then you'll see the next item below this is called accumulated depreciation. So at the end of the year, we typically do this monthly, we input this, but for a lot of taxpayers, they put it in at the end of the year when they do their tax returns and they get their return together and want to realize their savings here. Depreciation, in this instance, you would take the $350,000 divided by 27.5. You would take the flooring divided by 5. Now, I want to just input here that we're just using straight line depreciation right now for explanation. We're going to get into some things like bonus depreciation later on, but this is straight line depreciation. So the total depreciation expense in year 1 would be $14,727. You'll see that as it's calculated in the accumulated depreciation on the balance sheet. Now take a look at a profit and loss statement before we account for depreciation expense. So this is kind of the real world, what you had on your profit and loss here. Let's say you had rent revenues of $30K, you had your auto deduction, advertising. These are all just normal expenses you might have. Total expenses were $29,250. Now you'll note that some of these expenses are things that you may have paid out of your pocket anyways, even if you didn't have a real estate investment property. But if you've done so effectively, you've moved them to real estate investment deductions. Things like your meals, your telephone expense, and some stuff like that, that travel maybe, things that if you do it correctly, you can move these deductions legally to be tax deductions. But in all that, your net income would be about $750. So let's just say real world, you paid out all these expenses and you cash flowed $750. Okay, now let's look at the real P&L and how it looks once we add in depreciation expense here to your expenses. So it's the same as above, except now we've put in the depreciation expense that you're able to take as a tax deduction. So that $14,727 comes in here. You're gonna see now that your net income is a loss of $10,727. So this means that even though you may have had real income of $750 bottom line, on paper and on your tax return, you're going to have a loss of $10,727. So you can kind of see how you can cash flow from a property, but still show paper losses. And this is frequently done for many years until the property gets low on expenses. Now, if you're following along in our series on depreciation here, just be sure to keep this example in the back of your mind. We're going to use this a few more times throughout the series here. The main thing we wanted to get across to you now is to understand how depreciation works and how that can give you a tax loss, or at least get you down to zero or close to zero from your rental investments. Now, if you found this video useful at all to you, we encourage you to like and subscribe here, and also join us over at reitaxu.com in our real estate investor tax community, where we talk all things tax planning for real estate investors. Now, be sure to catch the rest of our series here on depreciation, because we're just scratching the surface with this stuff. We're going to get much deeper into some things like bonus depreciation, cost segregations, and things like that later on. In our next video to catch, we're going to be talking about basis and the importance of calculating and knowing your fixed asset basis.